Hi guys, welcome to our channel Edwards. I Subhadeep Karar will explain you on different financial ratios, their implications and will show you how to calculate them. So let's get started. Financial ratios. What are the financial ratios? Financial ratios are the most common widespread tools that used to analyze the financial standing of the business. It can be used to compare the different companies in different industries. It's purely a mathematical comparison, so it does not take into consideration the size of the company or industry. It only gives the raw computation of the financial positions and the performance. Financial ratios are created with the use of the numerical values taken from the financial statement to gain the meaningful information about the company. Who require these financial ratios? It can be internal or external user of the company. External users like financial analysts, retail investor, creditors, competitor, tax authorities, regulatory authorities, or the lenders. Internal users like management team, employees, and owners. For management team and the owners, these ratios work as a driver to identify the improvable areas, track company performance, and to make the decisions and create the roadmap to increase the profitability. So they are calling it as a profitability driver because it helps them to find the roadmap to increase their profitability. These financial ratios are grouped into 5 categories depending upon their derivations. These are liquidity ratios, leverage ratios, efficiency ratios, profitability ratios, market value ratios. Let's take one by one and let's see how to calculate and what their meaning is. Liquidity ratio. Liquidity ratio are the financial ratios that measures the company's ability to pay its liability. That can be short term or the long term obligations. Some of these common liquidity ratios are current ratio, acid test ratio, cash ratio, defensive interval ratios, and operating cash flow ratios, etc. Current ratio. It is most common use ratios for analyzing the liquidity ratios. It measures the company's ability to pay off the short-term liabilities with the current assets. It derived by dividing the current asset with the current liability. Though the ideal current ratio depends on business and the companies, but it is sometimes called as a 2:1. The lower current ratio means the company may not be able to pay its bill on time, while the higher ratio means the company has more money and it is safe to invest because it has the enough money in hand to pay off its liability. Acid test ratio or sometimes is called as a quick ratio. It indicates the capacity to pay its liabilities, current liabilities, without needing to sell its inventory. Among all the current asset, only the inventory part or inventory piece is depends on the market situations because it is not as much liquidate in nature compared to others. So for the calculation of the quick ratio, we will neglect this inventory from the total current assets. So how we will derive it? It will be derived as a ratios of cash equivalents, account receivables, and other current asset divided by other total current liabilities. If it is a 1, it is considered to be a normal. It indicates that company is fully equipped with exactly enough assets to be instantly liquidate to pay off its current liabilities. Cash ratio. Cash ratio is the most conservative way to look out or look into the liquidity ratios because it only consider cash and cash equivalent which is highly liquidate and can be used to pay off the liabilities of the companies. It measures a company's ability to pay the short-term liabilities with cash and cash equivalents. Although a higher ratio may indicate some degree of safety from the creditor's point of view because the company has more cash and cash equivalent, so they can pay off the debt anytime, but from the owner's point of view or investor point of view, it shows the inefficiency of the management because they are not using that cash and cash equivalents to create more and more profit. Another liquidity ratio is defensive interval ratio. It is the only ratio which shows in days, which present in days. It is a financial liquidity ratio which indicates how many days a company can operate with its current asset without needing access to the non-current asset or the long-term assets. What does it mean? It means the company is incurring expenses, daily expenses, which needs to be paid off from its cash equivalents, receivables, or short-term investments. That's mean, as we have seen in our past ratios, like quick asset test ratios or quick ratios, where we have seen we are considering the most liquidate assets. Here also we are considering most liquidate current assets which will be used to pay off or the to meet the daily expenses of the business or the debts. Operating Another is the operating cash flow. That is, operating cash flow is also showing how much cash is generating using its operating activities by the companies. Here, another ratio which is known as the operating cash flow ratio. It shows adequacy of the company's cash generation from the operating activities to pay its current liabilities. How it measures? It measures the number of the times a company pay off the current liabilities with the cash generation from the given period of time. Means operating cash flow divided by current liabilities. A higher ratio greater than 1 is preferred by the investors, creditors or the analysts. It means company can cover its current short-term liabilities and still have earning left over.